Well, good morning. I'm Elliot Kallen, President and CEO of Prosperity Financial Group, and I want to welcome you to another episode of Meet the Expert. This is our 11th episode in a series of 12 that we're doing. So next week will be the last one. I'll tell you about that in a moment, but we're glad that you're here. We are going to be reposting this, resending it out if you missed this morning's event. I just want you to know that one of our episodes has had 30,000 views out there right now, which is just tremendous. I'm in shock on this, but there's obviously some great information that's getting out there. So welcome. This is where we talk to people in the industry or related to the industry or just people in life about how to do things better. We're still in COVID lockdown. As a matter of fact, here in Northern California, we just went back into it as of this morning. I was ready to go to the gym on Wednesday. I'm ready to go I don't want to say get my nails done. That would be silly, but go to the gym and can't do that now. So we're kind of going backwards a little bit. And we know some states, clients in Texas and Florida, you've gone a little bit backwards, and I doubt we're going to do in-service eating again for the whole summer, but we'll see what happens on this whole thing. So welcome, everyone. Today, we've got for you two great speakers. We've got Joe Norton from Virtus, and he's going to be talking about minds over finance. In other words, how to do better, minds over money, and using your brains to make more money. That's what he's going to talk about, and minds over the market. And then we've got Maggie Dunn, who's going to be talking about environmentally correct investing, environmentally and socially aware investing in this world of political correctness. We'll give you an idea. We'll give her some challenges too as to the facts of who is really politically correct in the tech world and who is not. If you have questions, go ahead and send me your questions. You can text me your questions too. My cell is 510-206-1103. My email is Elliot, ELLIOT, at Prosperity, F as financial, G as group, prosperityfg.com. And our website is www.prosperityfg.com. We've got lots of advisors here, Emmett and Jamie, that I just saw this morning, myself and some others. We are here to help you. So don't be afraid to give us a call, and we'll do what we can, or send us an email. So today we're going to do that. I want to remind you, next week, we're going to do that, our final program in the morning, same time. And it's going to be about the two topics are estate planning during this COVID situation and dress for success. I'm wearing a custom shirt. This is one of those dress for success shirts. I've got my Sharks teal colors on for the hockey season that may or may not happen. They're folded up. They got the other material on. It's all fancy dancy. So let's have a little bit of fun today. So Joe, are you with us? Let's unmute Joe, and let me introduce Joe here. I just needed to unmute. Okay, I think we're live. So Joe is going to talk about behavioral finance, mind over markets, mind over matter. This is pretty exciting because there's a reason why most individuals, not our clients, but most financial individuals, especially do-it-yourselfers, buy at the wrong time, at the wrong price, sell at the wrong time, at the wrong price, no matter what they're doing, and they're swayed by TV, radio, whatever they're listening to. I just heard two ads this morning that if you're not making money on every trade on your stock, give us a call right now, because we can get you to make money and teach you how to do it in one class. Give us 1 hour and you'll be profitable. And so they follow these, and unfortunately, a lot of people don't make money doing it. We've been doing this now for 27 years. We're proud of our following. We're proud of our returns. We manage our own portfolios. We are a direct portfolio builder. So when you're talking to us, you're talking to the horse's mouth of portfolios, so to speak. So Joe is from a company called Virtus. They are a large money manager. They're what we call a strategic partner. And Joe, take it away and tell us about mind over markets, mind over behavioral finance. How do we make better decisions and every day in the marketplace?
That sounds great. Let me get this thing launched here, and then we'll see if we can't get this going here. All right, now. Can everybody see my screen? And it says minds over markets there. Is that where we're good? Okay, I see the thumbs up, so we're good. Well, first of all, thank you, Elliot, for having me and Maggie be on this call today. It's really a great opportunity to break from the monotony of being locked in your house for now coming up on 4 or 5 months. I'll apologize in advance for the squealing cockatiel in the back. Every time my daughter leaves the house, the bird wants to hear from her. So we're going to have that as our background music. But The presentation from Virtus Investment Partners, so I work with Virtus Investment Partners. We're a Hartford, Connecticut-based mutual fund company, and we're a little different from some of the other mutual fund companies that you might know and have heard of, in the sense that at Virtus, we are a collection of 18 institutional boutique money managers under the Virtus banner. So not necessarily the household name that some other mutual fund companies might be, but under that umbrella that Virtus brings to the table, we have a lot of really, really good active money managers in all ranges of products, whether it be equities, fixed income, etc. So if you haven't heard of us, hopefully this will be a great introduction for you. Barron's ranked us as the number 3, number 2, and number 2 fund family over the last 1, 5, and 10 years. So we've been doing something right in terms of putting together all these different disparate managers and bringing to our clients like Prosperity and Elliot a really good wide menu of things to choose from. But that's not what we're going to talk about today. Today we're going to talk about minds over markets, and the byline, if you will, is a behavioral guide to investing. And that's the most important part, because what we're going to talk about here, and let's see if I can't scroll down, is just what Elliot was alluding to, right? And this year in the markets has been a perfect example of how this investor's dilemma can really come out and rear its ugly head, right? And Benjamin Graham, for those of you who don't know, Warren Buffett, who most of you probably do know, looked up to Benjamin Graham as his sort of mentor and who he followed. And his comment there on the slide is the investor's chief problem, maybe his own worst enemy, is themselves. And what we're talking about is something that's come along in the last 10 years and become really big in our business. And probably most of you know a little bit about the idea of behavioral finance or behavioral psychology. And when we think about investing, we all know that you're supposed to buy low, sell high. You're supposed to be diversified. You're supposed to be patient, and you're supposed to make informed decisions. But what's really true and hard to recognize sometimes, that our minds, our brains are hardwired over millennia to survive on the plains, right? We have a fight or flight instinct. We have a fear and greed instinct. And we have lots of biases that come into play that make those 4 investing principles, which sound so easy when you just say them out loud, very difficult to execute on. So that's what we're going to just explore today, and allow me to keep going here. So this is something that many of you have seen, and certainly Elliot, you and I share about the same tenure in the business. I've been doing this since 1990. And, I used to always see these charts, and this is showing you the S&P 500, which most people think of when they refer to the stock market, and the growth of $1,000 invested back all the way back in 1925. And you can see it's nice little mountain chart that grows off to the right, and your $1,000 worth $8.6 million today, and it's a 10.1% average annual return. If you just looked at that and said, okay, all I need to do is set it and forget it, I'll make money as long as I have time in the markets, you're feeling really good. The problem is these little teeny lines that you see, if you look at these little craggly lines, well, in a short period of time, they're very, very, very scary and frightening. And even the upward moves sometimes are scary and frightening for people, as I think a lot of folks feel after this quarter. This quarter that ends today, by the way, markets, this S&P is up 16%, best quarterly return since 1998. And yet, if you look at the paper today, the market's down 4.5%. So we're going to get into those numbers a little bit in a few slides here. But it just goes to show you that this ride is important to pay attention to. This is the long-term return of equities. But the ride matters, and it's not always as easy as a chart like this looks. So why is that? And this is where we get into this idea of behavioral finance, behavioral psychology. And, there's a ton of these, by the way. If any of you are interested in, if you're avid readers and you want to get really more into the technicality of this, there's a book out there called Thinking Fast and Slow, and it's called, and it's by Daniel Kahneman and Amos Tversky. And Daniel Kahneman is the author of the book. Amos Tversky had passed when the book was published, but it's all about their work in terms of behavioral finance. And there's all these different biases that they studied that really make it difficult for us as humans. We're not irrational. We're human, right? And these are some of the things that we throw out there. So availability bias, I think about cruise ships right now. Just to give you, I'm going to run through these quickly, and then there's tons more. But if you want to learn more about all this stuff, I definitely recommend the book Thinking Fast and Slow by Daniel Kahneman. It's a wonderful, wonderful book. It's a great read. It's thick and dense, but it's definitely worth it for the topic. So let's go through a couple of these, and most of you will agree that these are things that we go through. So availability bias, the oldest example of that would be if you read about a train crash, a car crash, or let's say a cruise ship and getting COVID, for example, as a recent example. That's the information that's available to you. And I can almost guarantee that folks who have that become the first information that's available to them, let's use cruise ships as the most recent example, it's going to be a long time before they go back and say, oh, I want to go out and do a cruise, because that information was the available information to them as they started to develop that bias. It's a pretty powerful one. I'll jump next to pattern seeking up there in the middle. This is also referred to as the gambler's fallacy. So there's a lot of different examples of it, but the randomness of flipping a coin in our brains, we need to see patterns where there are none that exist. And so if somebody flips a coin heads 10 times, you expect that it's got to be the truth that the next one will be tails. It's due, or the pattern has to be reversed. We seek patterns where they don't exist in a random world. That can be very, very dangerous in terms of investing. An example I would use there would be value versus growth. Value has underperformed growth for 10 years, but there's no certainty that it needs to switch back, even though most people try to seek a pattern. So that's pattern seeking. Overconfidence, that's an easy one. 85% of people polled by Allstate Insurance said that they were above average drivers. We know that not to be the truth. I think the statistic for men was that 95% of them said they were above average drivers. We just tend to be overconfident in the way we make decisions and judge our decisions. And that can obviously lead to some investing mistakes beyond just mistakes in general. Certainly it can lead to investing mistakes. I spoke earlier about fear versus greed, and fear and greed being two big drivers of the markets. Overconfidence would be equated with greed in terms of that thought. Anchoring is when we tend to anchor to one bit of information and sort of stick to that. And I could go back again, even to something like that value versus growth bias. Confirmation bias is a good one. The easiest way to describe confirmation bias would be, think about where you sit. And again, I'm not gutting political, but just think, if you're more conservative, you probably access your news through a more conservative news outlet like Fox. If you're more progressive, liberal, whatever, left-leaning, then you probably access your news virtually anywhere else, right? Or at least that would be the story that's out there. So confirmation bias doesn't just exist in that example, but I think most people can really get that example. It can also exist as investors. We want to read, if we're bearish and we read a bearish outlook on the markets, that's the information that we're gonna look to say, see, I'm right. If we're bullish, then we're going to dismiss the bearish view and we're going to glom onto or be more prone to follow that bullish outlook. It's good to have information from both sides and not seek to find the information that only confirms what your bias is, and that's important. And then hindsight is just that classic Monday morning quarterback. We always sort of seem to think we knew that something was going to happen. For example, I'm sure there's people out there who said after the market from February 19 through March 23rd dropped 34%, the S&P 500 dropped 34%. And since March 23rd, it's up 37%. Hardly anybody, if you really think about it, could have predicted that the market would have that kind of drop and that kind of rise. But you will always find people who say in hindsight that they knew this kind of thing would happen. So that's those are a couple of these. This is the basis of this presentation. Everything else you're going to see is stuff you've seen before. Probably Elliot has shown it to you before. But I think the basis of this is to say, these are the things that we don't understand are kind of humming in between our ears, and they can trip us up as investors. wait a second. We're going to, this is the long-term return. There we go. Now we're going the right direction. Okay, so this is this idea of the behavior gap, or what Morningstar calls the investor gap. And what it is showing you the 20-year return of the S&P 500. So we're using that as kind of the market, the equities markets. And you can see over 20 years ending last year, 12/31/19, it's a 6.1% return. Pretty good return, right? Not as good as the last 10 years, which also I think is informative. If people at the end of last year going into this year, when they just looked at the 10-year return of the US equity market, they were starting to get their expectations pretty high. And I would say that greed factor was creeping back into the markets, because you were looking at literally double-digit annualized returns over 10 years. Over 20 years, the story is different. But look at this over the same 20-year period. Look at the average equity fund investor. And this is a group called Dalbar that does this study. And what they're looking at is the return on equity, the markets, and then people who own equity mutual funds and how often they're going in and out of them. Basically, when are they buying when they're greedy? When are they selling when they're fearful? And over that time, that friction creates this gap of a difference, between 6.1% and 4.3%. That's meaningful over a 20-year period to have that kind of gap in performance. And so while we obsess as a country, as individuals, over beating the market, it's true here, based on this example, that we often don't even beat our own investments. And that's, again, going back to the behavioral part of investing. So make sure I'm mindful of time here. So I'm going to go through just a couple more things that we should be mindful of, and then we'll turn it back over to Elliot. So this is a good chart, especially for this year, right? Over a long period of time, and I went back to the end of last year. At the end of last year, the average annual return for a 10-year number on the S&P 500 was over 10%. Over 5 years, it was over 13%. So people had started to expect pretty big returns, not a lot of volatility. What we've seen more recently is a ton of volatility, and this kind of shows you, this is the kind of classic bell curve distribution. Over any 1 year period of time, and we're talking about equities right now, because this is where most of the emotional carnage happens, right? This is where we make the biggest mistakes, because equities are historically the best return, but also the most volatile. And so over any 1 year period of time, you can see those tails go out to plus or minus 50%. So it can be a very scary place to be, being an equity investor over a 1 year period of time. That's why you put together a diversified portfolio. That's why you work with your advisor and you make a plan so that you don't get shaken off your mooring when things get volatile. But it's also very important to realize that's when we talk about investing for the long term, we mean that. It's not just a, hey, don't worry about the crazy volatility right now, just stick with us. It truly is, you need to give the markets, and in particular equities, you need to give them those longer time frames in order for those historical numbers, like that chart I showed you a couple slides ago, where it shows a 10.1% return for equities. You need to be able to give the market time to average that out, and we're going to show you why. This is bull and bear markets. We are technically, we were in an 11-year bull market leading up to February 19th, well, leading up to March 23rd, when the markets had dropped well past 20%. But this just goes to show you that bull markets are what are the majority of the time investing. And this goes back to that same number of 1925. They last longer, they're more gradual, they give you great returns. I heard somebody one time refer to bear markets as the repo man of bull markets. And it's true that in their length and duration is much shorter, but they are a violent snapback on bull markets, right? And you can see these numbers, and you don't have to absorb them all. We'll make sure you have the slides for you to disseminate. But what you can see is it happens very, very quickly, and it can be very, very painful. It can erase a lot of gains. But over time, you can see that the bull markets outpace and outlast the bear markets. And so it really does go back to that idea of you need to give it time. This is the one I was thinking of here. This is that, and we couldn't go back just for the chart purposes. We couldn't go back all the way to 1925, but this is pretty representative going back to 1960. And the orange line that's going through the middle there is that 10.1% return. Now look at those bars. Now the blue bars are what the market returned that year, the S&P 500, again, this is what we're referring to. And then the gray bar shows you that during that year, so look at 1975, right, where the market's up over 30%. But at one point during that year, you were down. After 2 huge down years, you were down over 10%. So it was very difficult at that point in 1975 to want to stay in the market to actually get that 30+% return later on that year. So intra-year, you'll see almost every time there's both positive and negative returns. And so you really do, this is, I think, very informative of why the market can scare people off of their long-term goals, even within a 1-year period. And this year, of course, has been incredible in terms of what it's shown us in terms of how the markets can be so volatile. Like I mentioned earlier, a market that was up a little bit, dropped 34%, and it was literally the fastest bear market, I think, on record, or certainly one of the fastest in terms of how it went from bull market on Feb 19 to bear market on Feb 23. Market had dropped the S&P 500 34%. To have come back 37% since that period of time, also unprecedented in terms of time. But what people need to realize is that this is where that long-term view really, really makes sense and really is imperative, because, you know, you hear those numbers, down 34, up 37. Why is the S&P down 4.5% through yesterday? And that has a lot to do with just negative compounding and just how quickly the markets can move. So again, to me, that is showing you that even in a year like this, where we felt like we've had 10 years of market returns all in 1 year, you have to keep thinking long term. And so, what are we doing on time? We're doing pretty good here. This just goes to the idea of, you know, as what we do for Elliot, for Prosperity, and for other advisors that we work with here at Virtus, is we try to provide information, and then managers that manage either bonds or equities or some combination that help fit into the very customized risk profile and risk parameters and financial plan that Elliot develops and his firm develops for you, the clients. And so what we're just trying to do here is show you sort of how to think about how to become more informed so that you can think about your plan and you set your expectations. And then, you know, the bonds have been really one of the best places to be if you own high quality bonds this year. But we've always talked about in our industry a 60-40 portfolio, 60% equity, 40% bonds. This is just a slide to show you that for the last 30 years that I've been in this business, bonds have been in a secular bull market. That's been a great place to be. And that's been really a driver of performance. But as all of you know, especially those of you who are more positioned more conservatively, we are now at a period of time where interest rates on a global basis are at historical lows. And so this slide is just here to show you that on average, and this is pretty amazing when you look at the 12/31 yield on the 10-year bond at 1.92 and think about where we are today at sub 1%, it's pretty telling. And what we're just showing you is that while bonds will always be part of your portfolio in terms of ballast, we need to actually be thinking forward, not just looking back, and realizing that starting yields are a good indicator of total return. So that's just something to be thinking about. So just a market stat, but setting expectations is one of the most critical ways to overcome those biases that are in between our ears, right? So making sure we understand why we still maybe need to be invested in equities, for example, even though they've been so volatile this year. Part of that is understanding where bonds might sit in the portfolio in terms of their ability to generate total return going forward. So, and I'm going to wrap it up in the next couple slides here. I think I'm going to jump through a couple of them, but you know, at the end of the day, there's 3 key engines: dollar cost averaging, rebalancing, compounding. We all know these. These are stuff that Elliot and you know inherently from just educating yourself. But think about this year in the markets. Being able to add a little bit of money consistently into the market has been such a better disciplined way to do it than trying to time a market where we've seen, like I said before, big move up, big move down, big move back up. Who knows where we sit today? As Elliot said at the beginning of this webinar, you know, we're now at the point where maybe we're starting to increase the restrictions on our mobility and our ability to get back out, even when we thought we had flattened the curve. So being able to be disciplined and not trying to time the market on when is the best inflection point to invest, that's critical. Rebalancing, this one sounds really basic, but I think it's really important to remember, think about it from an emotional standpoint, which is how we're trying to frame this whole presentation. If you think about rebalancing, any of you who are gardeners, that's akin to cutting your flowers and watering your weeds, which really doesn't sound like a great idea if I use the gardening analogy. But in investing, that really is what you need to be doing. You need to be taking your big winners and rebalancing your portfolio back to that risk profile that you would set up with your advisor. And so this is really a critical thing. And what we've seen is a lot of rebalancing in this market so far this year, because there's been opportunities to either sell stuff that had done well, buy stuff that had been beaten up, or just maybe because equities had gone so far so fast in certain areas and had lagged in other areas that you just wanted to right set that. So it's a real simple term, but when you put it into emotional terms, it's not that easy to do. Compounding, that one's obvious. It's a huge positive over time. It can be a big negative in a short period of time, as we've experienced this year, but it shows that you have to have that money at work. This is a good one. I'm going to go quickly through this, but this is actually kind of a cool chart. Most of you have probably seen what looks like the old chart of the elements, or a quilt pattern piece that shows you all the different asset classes and shows you that you really can't predict which ones are going to be the best year in, year out. And you know, I don't have the benefit of looking out at the audience and getting hands raised about who has seen this or hasn't. This is that same information. So you can see at the bottom there all the different asset classes that we're showing you, and those little colored dots corresponding to it. But rather than make it look like a quilt, we put it in this sort of dot matrix. And the reason for that is we want to show you that if you look at 2009, when emerging markets are up 80% and you've got something REITs that are negative, or actually I think that's fixed income, probably the ag slightly negative, you know, that's a huge, huge dispersion. And when there's a big dispersion, diversification isn't so fun. So we have a kind of a tagline where we talk about diversification means always having to say you're sorry. And this is another example here. It's just showing you when everything's bunched up really tightly, then when Elliot tells you you need to be diversified because you have to have diversification, we never know which asset class or what part of the market's going to do best next going forward. It's easy to agree when you're in a year like 2012. It's less easy in a year like 2009 or 2007, where you have so many asset classes that are negative. Being diversified means guaranteeing that you always have something that's not working in the portfolio, meaning at that time it's underperforming. Having everything perform the same might feel great in a year like 2019 when everything did well, or any other year where every asset class did well, but it's just not the case that happens, and certainly this year proves that out. So this is just a different way to look at the diversification concept. It's unassailable that it is an absolutely fundamental way to be a successful investor. But from a behavioral standpoint, diversification is difficult. You are often wondering, as I'm sure most of you can relate, why you own something when you're doing a quarterly review that hasn't performed, whether it's international, it's emerging markets, it was, credit in the first quarter, whatever it might be. You have to be diversified. It's not always that easy. Okay, so we're getting up on time. This just shows you, and this is just showing you that this is the last period, the last 20-year period, 2000 through 2019, where the average return on equities was 5.98. Sometimes, as Woody Allen says, he says 80% of life is just showing up. Sometimes in investing, it's when you started investing and when you ended. So if you were lucky enough to become a young investor in 1980 and invested for 20 years to 99, you had a 17.75% return versus our last 20 years, which included 250% drawdowns where you had 5.98. Now, a good advisor, a patient investor can do a lot over 20 years with a 5.98% return. But it is just sort of good to know and obviously I think important in terms of setting expectations. Having an expectation of a 17% return on a forward-going basis, probably unrealistic. Being able to work with something like the last 20 years, certainly probably more realistic. This just shows you the folly of market timing. I want to be mindful of Maggie. It's 11:30 right now. So why don't I just quickly wrap up here. This just goes to show you, and I mean, clearly this year has, I've said it twice now already. Feb 19 to March 23, 34% drop in the markets, 37% drop from March 23 through yesterday. Rise in the markets on the S&P 500. Very difficult to time when to get in and when to get out. And it had most anybody that tried or went to cash somewhere in somewhere in that third week of March probably didn't participate fully in the rise back in the market. So, I mean, this year I think alone is tells this slide story in spades. And this just talks about starting early and the power of compounding. Again, I think this is a point that's been drawn out for you. Elliot mentioned it at the beginning, so I'll finish on this slide. This is the prognostication is for show, and investing for the long term is for dough, if you want to use that term. This just goes to show you, these are headlines from 79, 99, 99, and 08. And just remember when you look at the financial press, especially CNBC, Bloomberg, things like that, they have advertisers that have to pay for every 15 minutes of airtime. And so you get sensational headlines like this. By the way, all of these would have, had you followed those headlines, would have worked out pretty negatively for you. So with that, I hope this is Elliot, I hope this is what you were looking for in terms of being able to put some perspective around what is never easy. The tenets, the basic principles of investing, they might be easy, but because we're human and because we have these behavioral biases, it's critical to have somebody help you through these periods of time, to choose when to own active managers, when to be passive, when to just get exposure to benchmarks. It's just critical to have somebody help you through this so that you don't get caught up in the emotion of it, and you get caught up in the long-term, goals-oriented, better outcome investing that is possible for all of us. So with that, I'll figure out how to delicately get out of these slides. But Elliot, why don't I turn it back to you, and you can take over here and we'll get out. I'll stop the share.
Thanks, Joe. Let me ask you a question before we go, since we have some people that emailed questions to me. We have clients. We did unfortunately have a few clients that bailed in March. They just got scared. And of course, most of our clients now, if they stayed in equities, are ahead for the year.
Yeah.
We've done a really good job redoing our portfolios. We're heavy tech, we're heavy science, we're heavy health. We're having what's called consumer durables like Costco and Walmart.
Yeah.
A little bit of financial like Visa and MasterCard, but not so much the banks, definitely not energy right now. So in diversification, we don't want to be completely diversified because we don't want to own areas. And that's where we're very careful at portfolio building. But if you just own the S&P 500, you own everything.
Yeah.
And so sometimes diversification also could mean over diversification, as you've seen, and you own too many places you shouldn't own. But how do we keep clients when the market goes down from thinking, always remembering that this is a long-term view, when the radio, the TV, the CNBC business, the Fox, MSNBC are saying, all you really need to do is go buy FANG stocks. Go buy 4 or 5 stocks. And why would you have to diversify beyond those stocks?
Yeah. No, that's a great question. And that's, when we talk about that 16% rise for the quarter, the market taking a big dive and then coming back up. And frankly, you're pointing out one of the problems that we deal with the financial press, Elliot, which is when I talk about the market, everybody's referring to the S&P 500, which is a cap-weighted index that, for example, those FANG stocks that you mentioned drive the majority of the performance. So the market, if you step outside and look at an equal weighted view of the S&P 500, many of these companies are still experience a lot of pain. The performance of their stocks have not come back, and you wouldn't want to necessarily be equally weighted, diversified through all of these companies. The FANG stocks are interesting in the sense that you even mentioned you do want to be focused, not necessarily just across the broad market, but also on the areas that you think will do well. For example, we've seen some winners coming out of COVID. Who knows where we're going to be in a year, right? We may be back to normal, but I think most people get a sense that going back to an office for everybody might not happen. The changes in the way companies recruit people, not needing to have them come to a specific city center and go to a specific expensive piece of real estate, that might change everything. So yes, being focused on technology, on some of the other stuff that you talked about, you know, the Walmarts, the Amazon, some of the areas that might actually be benefactors, or COVID-19 and all of the restrictions around our shelter in place and all that. Those might all be things that were already happening, sort of a digital transformation, but are being hastened or sped up because of COVID. But the thing that's really important for you, that I think you're trying to draw out, is for the investor who says, well, then all I need to do is own SPY or S&P 500 or the broad market. The broad market has lots of issues in it. But you as an advisor can specify where you want to get exposure. The S&P, which I think is what you're sort of referring to, everybody referring to that, is very dependent right now, much like it was back in 1999 back then it was Oracle, Cisco, Dell, Microsoft, Intel. Now it's the FANG stocks, it's Alphabet, it's Facebook, it's Amazon, it's Netflix. You know, at some point, you need to find what are the next disruptor companies. And so it's just not as simple as saying just own the S&P 500. And then frankly, most people were not that enamored with boring fixed income going into the end of last year. When you look at especially because of where yields were, and then you look at how well they performed this year, and you can see you need to own, especially if you're going to take risk assets like equities, and especially if you're going to overweight in areas like technology and those places where we do agree with you that there's a lot of opportunity for growth. You also have to be mindful of having some ballast in your portfolio. Is that kind of what you were searching for there?
Okay, well, I want to thank you, Joe. That was Joe Norton from Virtus. Thank you very much, Joe. Which brings us to our next speaker, Margaret Dorn, is from S&P. That's Standard & Poor's. I'm not going to say horse's mouth because I've already said that once this morning, and twice in the same session would be a lot to say. But we're glad to have you. So what Maggie is a specialist in is I call politically correct investing, but it's environmentally and social investing. And I do have some questions about that as we go. I've had some email to me of who's defining this, and Amazon doing business in China or Google doing business in China. Does that make them environmentally correct? And so let's talk about that. And Maggie, tell us, how does one make money? Is this a trend? Is this a fad? Is this going to be around? And is it a moving target? So welcome, Maggie.
Thank you, Elliot, and thank you all for taking a little bit of your time to hear what I'm about to say about ESG investing. Let me just take a moment quickly here to get my own slides up on the screen. And I'll be happy to get started here. All right, so there we go. Can everyone see the screen? Quick thumbs up. You just want to make sure I'm not talking to slides that aren't appearing. All right, it looks like we're good. So again, thank you to everyone for having me join, and Elliot for allowing me the opportunity to speak with regards to ESG investing. I do, again, work for S&P Dow Jones Indices. So you heard Joe speak a lot about the S&P 500. So the S&P 500 is calculated and is owned by S&P Dow Jones Indices. So we spend a lot of time talking about the S&P 500, but what a lot of people don't realize is that S&P Dow Jones Indices and S&P have quite a substantial background in sustainable investing or in ESG investing. And what's particularly is interesting, especially in this current environment around COVID, as well as some of the social movements going on across the country, is how much at the forefront sustainable or ESG investing has really become as of late. And I think it actually aligns quite nicely with what Joe spoke to regarding behavioral investments, because the fact of the matter is that people want to feel good about their investments. They want to know where their money is going, and they want to feel good about it. And so behavioral investing, in some degree, in some spaces, has a lot to do with the movement towards ESG investing as well. So before I get it started into some of the details behind what ESG investing actually is, a quick background on S&P's history in the sustainability space. It actually started over 20 years ago when we launched the first ever global sustainability benchmark, the Dow Jones Sustainability Index. So this index really pioneered sustainable indexing and has quite frankly shaped the corporate sustainability practices all over the world since it was launched. So it's important to understand the foundations of what and who not only S&P is in the sustainable space, but what sustainable investing actually is. So I'm going to take everyone down on a quick history lesson because I think it's important, and I hope not to bore any of you too much on the history side of things, but it's important to understand when it all began. So when you look at the true foundations of socially responsible investing, it actually goes back thousands of years. So but when you look at modern day occurrences of socially responsible investing, it actually came in the late 1700s when the Quakers in Philadelphia, at their yearly meeting, prohibited members from participating in the slave trade. So you see that the dynamics and the core of sustainable or socially responsible investing have been around for quite some time. But really the rising popularity of socially responsible investing came in the early 1900s when investors began to avoid those quote unquote sin stocks. So when I'm talking about sin stocks, I'm talking about companies that dealt in businesses such as tobacco or gambling or alcohol. So really social responsible investing became ethical or values-based investing, which served its purpose for many, many investors. But one of the issues you had is that by removing those sin stocks, oftentimes it came with a downside. And why that is because by eliminating those sin stocks from a portfolio, it often meant that you were excluding entire sectors, like the energy sector. And that often led to a lack of diversification and subsequently lower returns. So socially responsible investing, or SRI investing, which was very ethically or values-based, often eliminated entire sectors, which removed diversification and subsequently caused a lower performance, which wasn't necessarily a good investment for investors in the long run. So ESG investing is actually quite different than SRI. And why that is rather than taking a values-driven approach, ESG is a data-driven approach. So it looks to incorporate those new forms of financially material data into investment screens that are not always captured by traditional regulatory filings or financial analysis. So really, it's just an additional lens into a company's business model or business practices. So unlike the exclusionary process of socially responsible investing that oftentimes detracts from performance, what you see with ESG investing is that you don't necessarily have to sacrifice those returns. So you see that in that second point. ESG does not mean sacrificing returns, because when you look at the resources behind efficient companies, that usually means that they're a pretty well-run company as a whole. And not only that, with ESG investing, you also have more of a focus on broad market exposure. So not eliminating entire sectors that can detract from performance. So with broad market exposure, it's now possible to go with the market, if not better, or if not have better returns. So I think that's important, that when you think about the overall theme of ESG investing, it allows for investors to do well while still doing good. So I'm a visual learner. So I thought I'd include these cartoons into the conversation today, because I think it's important to get a grasp of what the E, S, and the G actually stand for. Now, granted, this is a bit tongue-in-cheek, but the E stands for environmental. So you see here the gentleman is writing climate change threatens our existence, and everyone's falling asleep in the audience there, although they shouldn't be, because it is quite important. And then the social side of things, so the S stands for social, and here you can see what seems to be a pretty male-dominated boardroom who are all indecisive about, the steps that they need to take. And then finally, you see the G, or the governance side, and you see that, there's an entire, again, boardroom of individuals who are saying that they're going to split across the bank accounts, hire the corporate jet, and fly away into the horizon, or the sunset there. So and again, this is a bit tongue-in-cheek, but it describes a little bit in a visual sense what the core of the E, S, and the G actually are looking at. And if we move forward to the next slide, we describe them in kind of a more down-to-earth terms. But first and foremost, environment, or the E in the E, S, and G, tends to focus on a company's climate change policies, policies that they have in place around carbon emissions reduction, as well as things like resource management. And so on the social side, the S tends to be those policies like gender and diversity that a company has in place, or labor standards, and quite frankly, most importantly, human rights. And then on the governance, so what does governance mean? Governance usually tends to include metrics like executive compensation, or management structure, or board compensation, and shareholder treatment. So all of these metrics, or these E, S, and G metrics, are incredibly important to understanding, how a business runs, and can be very essential into understanding or having a clearer picture of what the long-term financial materiality of these metrics could be on a company as well. So these are data-driven points that allow us to get a deeper dive, or take a deeper dive and lens into the policies and the management of an underlying company. And so there is, beyond the social or the environmental and the governance side, when we look at what ESG is actually shedding light onto, it is that it's shedding a light on real economic impacts in a client's portfolio. So you see here, you're looking at a demand side as well as a supply side. And on the bottom section, we have a little blurb, and it seems not to be showing up on the screen, so I apologize for that. But it's around the Paris Agreement, which was a landmark environmental accord that was adopted by nearly every nation in 2015 to address climate change and its negative impact. And that has subsequently really influenced policy, not only for governments and economies, but for companies as well. And why that is when you think about the strain on resources, right? So with a population that's up to 9 billion by 2040, with 2 billion more middle-class consumers expected by 2030, and 20% of the world's population living in water-stressed areas, you can understand that there's a resource-stressed economy and a resource-stressed supply side. So you have erosion of natural resources, pollution, exploitation, and then this constant changing conversation around climate change, where whether you believe in it or not, we're seeing more extreme and unpredictable weather events. They're causing strains on both people, economies, and companies. So when you think about who the ESG messaging is or who is really demanding the change, and who is really demanding, that ESG investing come to the forefront, I use this chart from our friends at DWS, because they speak a lot to the impacts of ESG investing, both within millennials as well as women. But there is definitely a demographic demand from both millennials as well as women. Now, that doesn't mean that they're the only demographic that is looking at ESG investing. But when you think about the impacts on the global economy that both millennials and women have, it's important to recognize the importance and the impact that ESG could have on investing moving forward. So when you look at millennials, the global net worth of millennials is predicted to more than double by 2020, with estimates for anywhere from 18 to 24 trillion. Now, granted, we've had a little bit of a fallback in 2020 as with regards to that, so that may have been slightly on a pause, but we're still seeing that upward trend of global net worth within the millennial segment. When you look at the amount of assets that they're putting into the ESG or U.S. domiciled ESG investments, that's upward of 15 to 20 trillion, which could double the entire size of the U.S. equity market. We've seen this almost fast forward too, as we see the demand for ESG investing rise. We've seen that this, almost take a faster pace as more millennials are interested in accessing ESG investments in the current market environment, with both, again, COVID and some of the social movements going on around the world. So when you look at the percentage of millennials looking to allocate to responsible investments in the next 5 years, it's over 90%. So then if you look at women as well, women control 14 trillion, or roughly 51% of the personal wealth in the U.S. So that's an incredibly significant number. Things like increased education, longer lifespans, and quite well a narrowing income gap that has made women a faster growing economic power than actually China and India combined. I always think that's a really interesting stat. So, and then as far as their interest in ESG investing, women are twice as likely to consider sustainable investing alongside return when investing. So both millennials and women are definitely driving the demand behind ESG investing. But I want to be very clear that it isn't just those two demographics that are driving or that are looking to educate themselves further around ESG investing. I actually published a blog post several weeks ago called Move Over Millennials, and it addresses the fact that it's investors across all ages and genders clearly have preferences for ESG investments. And I'm a millennial, so you have to, I have to admit that to everyone on the call today. So, but as a millennial, I give onus to the fact that when you look at ESG investing, it tends to overlook that baby boomer demographic. But I think it's important to remember that millennials inherited their core values from baby boomer parents whose activism, specifically during the 1970s, and strong voices led to the establishment of a lot of the first sustainable funds. So in recent reports, actually, that came out by Allianz, and I have some stats here, baby boomers are actually more likely than millennials and Gen Xers to say that the reason that they want to participate in ESG investing is to encourage companies to be good corporate citizens. So encouraging companies to be good corporate citizens is a dialogue that we're hearing all across the spectrum these days. So customers that are interested in learning more about the ESG space tend to be looking at areas like what social causes the companies they invest in support, what type of corporate citizens, again, that they invest in, and how the companies and products and services impact people's health and well-being. 85% said how the company's products and services impact people's health and well-being was important to their overall discussion around investing in a company. So when you think about that, that's incredibly important to understanding what the trajectory of ESG investing will actually look like. So as more millennials inherit and come into more money, but also as baby boomers throughout the COVID environment and coming out of it, continue to explore global stewardship and corporate stewardship, this is going to become an ever-increasing conversation in a client's portfolio. So with the demand, you're also seeing a growth for ESG funds. So this is a stat coming out of Morningstar. What you see here is the sustainable funds and estimated annual flows have almost tripled over the past year alone. We've seen that double in just the first half of 2020 as well. So the assets flowing into these sustainable funds as well as ESG investments is quite staggering as we, again, continue to evolve and to, shine a greater light on corporate stewardship and global stewardship as well. So I'll stop there because I think that there are quite a few questions. But before I take some of the questions from Elliot, I think one of the important, parts of this conversation is around understanding the data set and what the data set is ultimately looking to accomplish. So there's a lot of different ESG data out there and a lot of different mutual funds and ETFs and other types of products that use different sets of data. So when you're exploring what ESG index or what ESG fund or what ESG mutual fund to be investing at, make sure you work with a financial advisor like Elliot who can walk you through what some of the sustainable metrics are and what's most important to you, because that will help them better identify what the right ESG investment is for your portfolio. So Elliot, I'll stop there and see if there are any questions.
Maggie, thanks. We do have a few questions. That'll be great. So do you think this is going to be long-term or is this a trend?
This is very much long-term. Again, this is something that has been evolving over thousands of years, right? From the first sustainable or socially responsible investments and into what we now call ESG. So this is a long-term trend, or this is a long-term investment, because again, you're looking at an additional data set, an additional lens into the sustainability metrics of a company, which isn't something that's just important for a year or two. And as we see increases of, importance around climate change, and as we see policies starting to be enforced, not only in the US, but around the world, ESG investing is going to become increasingly more important in a client's portfolio.
So let me ask you a couple questions about Apple, the darling of ESG and the darling of millennials in this country. They've got the most loyal fan base of any product and company I've ever seen in my life. They make their products, or go deal their products in China. They sell them worldwide. A little harder for them to sell in China right now. We know that we're at a bit of economic war with China, and we may be at economic war with China for some time. They've got 1 million slaves. They've got 1 million people in concentration camps, Muslims and so forth. So I could make a pretty good argument that doing business in China and involving the Chinese Communist Party is not an ESG type of situation. Yet they're the darling of almost every ESG company out there. So how do we justify, okay, I'm separating my money out because Apple in the US is good, governance, Google is good for governance, but they all do business with the Chinese Communist Party, which is a horrible organization in the world. How do we justify this?
So it's not necessarily about justification, and I hate to pivot the question, Elliot, to a place that may not be in the exact direction that you were hoping I would go, but again, it really comes down to what the data set is. So some data sets around ESG will be more exclusionary, and becoming more exclusionary, you may encounter a fund or an index that excludes China because of some of the human rights atrocities or social issues that the country has had in the past. But the fact of the matter is that usually is more in line with socially responsible investing or the traditional SRI investing, because ESG, again, is utilizing a data set rather than to be exclusionary, it's actually quite inclusionary. So usually ESG data is being utilized to identify the worst offenders. So by identifying the worst offenders in ESG, then they can exclude those companies that have been identified to have, again, the greatest offenses within the ESG category. So, I think it really just depends on what the data set is weighting and or overweighting in certain categories, whether it be E, F, and G, and whether or not you are comfortable with an investment that may be more exclusionary in nature, that may exclude an Apple, because by excluding an Apple, you may also be giving up the return scenario in which Apple can provide in a long-term portfolio. So an ESG is more about marrying, the relationship between values and performance, and not necessarily being as exclusionary in nature as a socially responsible investment has been in the past.
So another question that's come up, concern is how much politics plays in this. Right now, we are in a world of volatile politics, or the U.S. of volatile politics. And one person's belief is definitely not another person's belief. And we see companies dropping from Facebook, advertisers dropping from Facebook. I think they're up to about 160 advertisers that have dropped Facebook, at least for the moment. And then years ago, I recall there was a movement to drop Israeli companies from ESG because of the BDS movement that was working down there. So you can definitely pull politics in and get it and have it rear its ugly head. So how do you avoid that? Because politics, your politics and my politics don't have to be the same. But when it comes to investing, I don't really want you influencing my politics on what I can invest in. How do we deal with that?
But I honestly, Elliot, I think that's the beautiful nature of what ESG investing is, right? Because ESG, and I hate to be, being redundant here, but ESG investing is a data set. So it's not values-based. So irregardless of our political affiliations, ESG is accessing data and financially material data that can give us an additional lens into a company's, policies, metrics, and business operations that aren't traditionally in standard financial analysis. So irregardless of politics, ESG is just focusing on financially material data. So I think that's what's the beautiful thing about ESG versus, again, a values or ethical based investment strategy like a socially responsible investment, because you're focusing in on that financially material data and removing the political noise and the other noise that tends to be centric around those other types of investments. And that's what's so integral and so important about ESG data sets and its incorporation into financial metrics.
Okay. Maggie, that was great. Thank you. I think what you've proven is that you can have a strong belief in environment and social governance and socially aware companies and combine them with your investment philosophy. Is that what you believe in? Correct.
That is the intent of ESG, is the fact that you can truly marry and balance the whole thought process around what you incorporate or what you feel is important from a values perspective, but also marry that with investment performance as well.
Great. And you've been brought to us by our friends at Deutsche Bank, DWS, so I know they would be interested in hearing from our clients about that as well. So thank you very much. So
you're welcome. Thanks for having me.
Great. We've had two great topics today. We've gone on a little bit long. That's okay. Next week will be our last of the original series, and then we'll continue them. Joe Norton, Maggie Dorn, you both were fantastic. Again, if you want to reach me, I'm at Elliot, ELLIOT, at Prosperity, F like financial, G like group.com. Our website is www.prosperityfg.com. Got lots of advisors here that can help you out. We've been doing very well for our clients during this lockdown, and we've produced now 11 out of 12 shows, which is what our goal. So thank you, Chris, from the background. Most people never will meet Chris in the background, but he's done a great job of these. Next week for our last live show, and then we'll be doing interviews, 10, 15-minute interviews on particular topics. Next week, we have two speakers. Craig Judson will be speaking about estate planning and the essentials during this COVID lockdown. I just had a friend whose 91-year-old mom passed away from COVID, so these are important topics. And we'll be having another speaker talk about dress for success, how to do a great job, what do we do, how do we look good here. I just noticed I've been told, Elliot, you have a little stain on your shirt, and I don't know how I get through a day without a stain on my shirt, but that's me. Maybe I need to find colors that are better stain hiders for me. So on behalf of Prosperity Financial Group and your team here, first I want to wish you a terrific July 4th. It is the American Independence Day. It's the anniversary of the signing of the Declaration, not the American Constitution, but the signing of the Declaration. We had a lot of people who put their lives on the line and committed what was called treason at that time to come up with this amazing concept called the United States of America. So thank you, and we're glad to have you here, and enjoy your family, your friends. It's a long weekend. Most people are off on Friday. Have a great weekend and be safe and stay healthy. On behalf of Prosperity Financial Group, have a great long weekend.